So it's still holding on to gains. I mean, that recovery that we're speaking of, at least as of now, it continues to be intact. Let's take a look at some more names. IndusInd Bank, for whatever it's worth, is again trying to find its feet today. About 0.7% on the higher side. Now, Mr. Tulsian, I mean, this stock is obviously caught up in a storm at the moment. But given where valuations are, should the brave hearts go out and even try and pick it at the moment?
So we are referring for IndusInd Bank?
Yes, sir. IndusInd Bank.
So yesterday, stock having bottomed out, yesterday also I've said that yes, the stock seen having corrected to about 1500 rupees level. Though, we have been giving the buy call from 1400, if you see for the last couple of weeks, every alternate day. And post results, it has swung to 1600 plus. But yesterday having corrected by about 125, that gave us a very good opportunity. And today it is in fact virtually ruling at the same level. But yesterday, the way we have seen the carnage in the share price, probably, people thought that it can move back to 1400. But yesterday also I've said that yes, I'll be buyer at the current level, and even taking that same into consideration, probably I'll be, because ILFS, once this provisions having made, probably I'm expecting in fact the recovery process to happen. And so, whatever negate this contagion effect of the DHFL scene can get negated by the ILFS recovery process, to be seen maybe in the next 1 month or so, because government will not be lazy sitting on that. And the Nitin Gadkari's statement that yes, the process will get resolved in the next 100 days will definitely yield results. So yes, maybe allow the budgets to pass through, and then thereafter the process of the ILFS debt resolution will start, which will be seen positive for all the banks, including IndusInd. So we are a buyer in IndusInd Bank at the current level.
Okay, by the way, fresh 52-week high for Apollo Hospitals, and how things have turned. Remember, it was just about 3 months back when, because of those pledge shares and that big decline in the stock, it almost went to its lows. Just pull out a 6-month chart on Apollo Hospitals, and of course the last quarter's numbers were good. The company looking at pledge issue, and we discussed it on that day when the pledge, some of the pledges were removed, that perhaps this could really be a big trigger for the stock. I remember, Mr. Tulsian, having this discussion with you that day. I think it was 1100 something that day, now 1400. Time to book some profit here, or let this run?
Yes, Anuj, on that day it was ruling at closure to about 1145, 1150, if I'm not wrong. So definitely yes. And what we are generally seeing in case of Apollo Hospital, that it is seen a high beta stocks. It swiftly moves up by 150, 200 points. And then again corrects. I'm not expecting the prices to again come to sub 1200, but definitely the profits can be booked now at 1400 level and can be looked to buy back again at 1300, 1310. Because the reason for taking the bullish or keeping the bullish call on the Apollo Hospital, that you have this only as the considerate or maybe the credible healthcare company, and in fact people are not taking any call on the pharma stocks, rightly so. So if you want to be into the healthcare and pharma, probably this is the only safe stocks, but there is no harm in booking profits at 1400 and look to buy back again at 1300, and we are keeping the positive bias, because if you really see the monetization of their insurance and the Navi Mumbai hospital having turned around and all sort of things, everything is seen positive in the pipeline going ahead.
Okay. All right, Mr. Tulsian, we will let you go on that note. Thanks very much for being with us. Have a good weekend. We will catch you with the market again. More stocks moving around. I mean, look at the mid-cap space. Just an example, Make Money Organics. I mean, there are people looking for bargains, and that's what today is all about. This is a stock that's quickly rushing to the highs of the day as well. Key player in specialty chemicals. Before we invite our next guest on the show, you were making a quick point. Apollo Hospital, same question. I mean, given this massive rally, what would you do on this?
In fact, I had recommended this, I think, in the 3rd week of April. And I had a price target of about, I think, 1440, if I'm not wrong. I think we are close to that. And with the sort of results they have shown, clearly, I think it is quite great that the stock has moved to these levels. But I think possibly at closer to 440, 450 1440, 1450 levels, I think one can book out and possibly look to buy back again at lower levels when the market corrects.
Okay, a couple of more stocks breaking out right now. One is SRF. Just see that stock. Since we pointed out Make Money, I'm just looking at some of the other stocks. SRF is now at the high point or almost getting there. And GSFC, slightly illiquid stock compared to the, and considering it's in F&O. So GSFC as well right now inching higher. Amrish, before we thank you, just wanted your thoughts on SRF. It's a stock which has done remarkably well all through last 1 year.
In fact, SRF, I don't really track it very closely, so it's a bit difficult for me to really comment on that.
Any other particular chemical or fertilizer stock?
But the other stock which I was thinking of recommending was Indian Hotels, which again has been extremely steady at these levels. And I think the last whole year wasn't too great for the hotel industry overall, looking at the sort of floods which we had in Karnataka, Kerala, and then the sort of aviation issue which we had. Despite that, we have seen Indian hotels actually inching up on the occupancy levels, which has gone up to about 68%. Again, this year we should be seeing at least another 2,000 more keys. Increasing for Indian hotels, which actually means close to 1 hotel per month for the next 12 months. So looking at the sort of growth which we'll see possibly in the next 2 or 3 years, which is a CAGR of about 11%, I think at these levels where it has consolidated at the region of about 145, 148, I think it's a great buy. Looking at a price level of about 175, possibly in the next 6 to 8 months. And in case it happens like Apollo Hospital, we could possibly see those levels in 3 months.
All right, Amrish, thanks a lot
for
joining us. Well, on that note, let's invite our Alpha Manager for the day, Pankaj Tibrewal, Senior Vice President and Equity Fund Manager at Kotak Mahindra Asset Management, is with us. Pankaj, hi, good afternoon. Thanks a lot for joining us. So, your thoughts on the kind of volatility that we have seen and this whole DHFL issue and the fear of contagion, your position on that?
Good afternoon, Anuj. Good afternoon, Surbhi. I think clearly one of the biggest event is behind us, which is elections. I think market is taking a great source of comfort from the mandate which this government has got, which means that there's a lot of policy predictability down the line. We have been saying that financial sector for next few months is in a fragile environment right now. We have seen one of the NBFC, HFC episode played out a few days back. I think we need to be a little careful. I think NBFCs is still as a sector not out of woods. But what this event over the last 6-8 months have done post RNFS, that in this sector men's have been separated from boys. And if you look at the daily borrowing by most of the players, some of the players are getting funding at very attractive rates. We saw in the fourth quarter numbers also some of the NBFCs grew very handsomely. So clearly market is making a distinction between players in this sector, and in our view that is going to continue. But what has happened in this entire financial sector is that private sector lenders have gained disproportionately. In our view, the pricing power which private lenders are enjoying, I think they have never been in such a sweet spot in the last 5-6 years. We have been overweight on the private sector lenders for a while, and I believe that in this FY20, 70% of the incremental profit growth in Nifty is expected to be coming out of the private sector lenders plus one PSUs. So I think banks would contribute handsomely because the provisioning cost would be much lower than what we have seen in the past couple of years.
Okay, well, that's the premise, I think, on which the rally was also based. Pankaj, good afternoon. Thanks for joining in. You manage very exciting funds. You look at the mid-cap universe, the small-cap universe. And my question is this. The hope since the exit poll day really was that the mood is swinging back in favor of this side of the market after big outperformance. Now, this whole NBFC issue, some kind of dwindling in FII flows, is that changing that whole theory? Or do you think that going forward, next 6 to 8 months, mid-caps can still outperform large caps?
Surbi, our analysis suggests that on a rolling return basis, whenever mid and small caps underperform by more than 15% to Nifty or large caps, I think the next 12 to 18 months, this mid and small cap segment tends to do extremely well and outperform the large cap. That theory still exists. We believe that in this entire environment of pessimism, where the broader markets have lagged behind the narrower markets by quite a margin, there are opportunities emerging and good quality companies are available at decent valuation if one takes a 2 to 3 year call. And in our view, going forward into next 12 to 18 months, we believe that the broader market should outperform the Nifty or the narrow market.
Okay, broader market should outperform. I was just going through your fund. You have, positioning in Apollo Hospital. I know you may not want to comment individual stock, but is the space still exciting? We've seen a fair bit of gains over the last 2 or 3 months.
Anuj, if you look at our philosophy, we would like to bet on companies where there is a strong moat, where there is an incremental change in return on capital and the capex cycle is behind us. Some of the names in the portfolio and one of the names you mentioned fits in that bill exactly. Also, if you look at our fund, we have been positive on specialty chemical as a space for quite a long period of time, and I think that bet has turned out to be quite rewarding. If you look at over the last 1 or 2 years, I think the China issue, and overall if you look at most of the global agrochem guys are looking at India as a second source, and Indian companies are at a very sweet spot to increase their market share in the global outsourcing pie. The companies we speak to across the channel, they are saying that demand is not an issue today, supply and execution is the only bottleneck, which is more internal to us. So I think most of the specialty chemical companies are in a very sweet spot today, and there's a very strong earning visibility for at least next couple of years. Also in the portfolio, if you look at cement, I think this is one sector where we believe the consolidation has happened. Pricing discipline over the last few months have come back again in this sector, which bodes very well for the companies in this space. And most of the companies in both the specialty chemicals and cement lies from the mid and small cap space. So the point which I'm trying to say is that it's not that mid cap as a segment has done extremely badly. There are pockets in mid and small caps which are at their lifetime highs or all-time highs, and I think it's a classic bottom-up stock picking opportunity. If we are not expecting the same kind of market which was there in calendar year 2017, I think the lower rung quality companies will still struggle. The environment is very risk averse today. The ecosystem will not let the weaker companies exist beyond a point, which is good news for larger and stronger companies in each and every sector. They will see a disproportionate market share increase over the next 24 to 36 months.
You're talking specialty chemicals. It's actually a good day for some of these companies, Pankaj. I was just taking a look at the names. Let's pull up Meghmani once again. 1.5%. So buyers are really queuing up. SRF, Meghmani. These are interesting facets of today's trade. Look at GSFC as well on the fertilizer side. So interesting play on the mid-cap screens. You mentioned cement. I just want to go back to that, Pankaj. Yes, you do have holdings like Ramco Cements, etc. Now, we have started hearing of price cuts in the south. There was a price hike around February onwards, and now we're just hearing that Andhra and maybe Telangana, there are some price cuts. Is that only a seasonal thing you feel? I mean, thematically, over the next 12 months, are you expecting cement stocks to continue doing well?
Yes, Urbi, our entire thesis is based on the fact that if you look at last 5-6 years, supply exceeded demand. Supply increased at a CAGR of about 11%, whereas demand increased at a CAGR of about 5-6%. We believe over the next 3 to 4 years, the equation would be completely reversed. You would see supply increasing at a CAGR of not more than 4 to 5%, and demand increasing at a CAGR of 7 to 8%. I think if that equation holds true, I think on and off you will see maybe price decrease or increase. But on a structural basis over the next 3-4 years, we should see a 3 to 5% CAGR increase in pricing, which should be reasonable for a lot of cement companies. Also, the commodity cost, which is a derivative of crude, is in favor of most of the cement companies, which is petcoke. Transportation costs are subdued. So on the cost side, you have the benefit. On the pricing and demand side, if it holds good, I think you have a strong earnings growth momentum, at least for next 12 to 18 months in this sector.
Okay, we're just discussing some consumer goods, and in your fund you have a decent exposure. In fact, 12% of your emerging equity fund is in that space. What's the trigger here and valuation? Some of these stocks are now at historic valuations.
I think, Anuj, if you look at, there's a lot of talk about consumption slowdown. We are not saying that, yes, pockets of consumption are not slowing down. Like automobiles, we have seen very bad numbers for last few months. But despite of all this pessimism, if you look at the fourth quarter numbers for consumption basket, it's not as bad as it looks like to be, or it's not as good as we may want to be. Look at the staple side. On an average, staple companies grew their top line by about 11%, which is not bad in a 5.6% GDP growth. The paint companies grew by about 10% in terms of their top line, and discretionary companies grew their top line about 14-15%. In our portfolio, we are more biased towards consumer discretionary, because that's the space which is represented more by mid caps and small caps. We believe there are some of the companies which are in a very sweet spot. We have been positive on this space for almost now 3.5-4 years. We believe that as we cross the $2,000 per capita income, I think consumer discretionary in many places in India will see very strong growth. Just to give you an example, you may see AC name in our portfolio. You may see consumer durable, kind of a supplier which is a part of our portfolio. So we believe that there's a strong runway for growth in this sector. Yes, valuation is something we need to keep in mind. They are not as cheap as they were available 3 to 4 years back. And obviously, that's something which we keep on internally debating at what valuation one should look to trim. If the runway for growth is much higher, and if they keep on delivering 25-30% growth, I think we are comfortable holding those names.
Okay, all right, Pankaj, we will wrap it up on that note for today. Then thank you for joining in with thoughts on the mid-cap, small-cap market. Pankaj, for one, believes that the next 12-18 months could actually be good for the broader market. It's a good time to pick stocks. Stocks that are actually doing okay. At around 3 p.m., we're still holding on to the gains the Nifty made. There's about a 40-point up move underway on the Nifty for the time being. Well, the one stock that has been in the limelight for all kinds of reasons last 48 hours is DHFL. And our colleague Nisha actually managed to speak to the man of the moment, the exclusive conversation with Kapil Vadhavan. We need to take a break. As we take the break, we're going to leave you with some highlights of the conversation and what his claim was in terms of the next few days at DHFL. Listen to this. We'll take a break and come right back.
We have been talking about the liquidity crisis which has really hit the NBFC sector. Is it just liquidity, or with your papers being downgraded by the ratings agencies, now that you have lesser avenues for gaining any capital for your business, is it an issue of survival and therefore solvency?
Let me address this by saying that DHFL has been one of the largest housing finance companies in the country, with a prime focus on tier 2, tier 3 markets, focusing on the lower and the middle income segment. Incidentally, we are the largest contributor to the Pradhan Mantri Awas Yojana, where more than 100,000 units have actually been financed by DHFL over the last 3 years. Now, come September last year, yes. 2018, yes, we abruptly got caught into a liquidity jam. And I'm not talking about just DHFL, it was the sector as a whole, right. Both the NBFCs and HFCs. Post that, right till today, all the market participants have found it extremely difficult to go out and raise fresh resources from the marketplace. Right. Clearly, DHFL has had a strong history and standing with, more than 30 banks in the country, whether it's in terms of term loan borrowings or going out and selling down loans to them, right. Which has been much appreciated by the industry, by the participants, that the quality of assets has been of absolutely pristine value, right. Which obviously helped us from September onwards till today.
So far, you held on pretty well,
Yes.
Kapil. And you always took pride in saying that we have neither defaulted nor delayed. But you recently delayed, and you're saying a cure period of 7 days, but that is being understood by the rating agencies as a default scenario, tantamounting to lack of confidence in you really be able to service the further maturities as far as commercial papers are concerned. So do you think, is it a solvency question now more than liquidity? What went wrong in the last 1 month?
You know, firstly, it's not a solvency issue at all. I think this misnomer, and I've heard, you know, some of the market experts talk about, you know, solvency issues, about DHFL being tagged with some of the other companies which have had similar problems from different sectors. We are a financial institution. We have underlying assets which keep on giving us cash flows even till today,
Right.
and will continue to do so. Now, if you abruptly stop the lending activity,
Right.
for a large institution like us having more than 1.25 lakh crore AUM,
Right.
and expect me to start paying down the liabilities of all my creditors, you know, even a bank today, you know, in that situation would not survive.